Good Wednesday morning, Market Chameleons, and everyone join us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. You there, D? Well, as D's coming in, let me get the disclaimer started. Everyone, we are not a
Good
registered.
morning, Will.
You want to do the disclaimer?
Yeah, good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for. There's the disclaimer.
Excellent.
I'm going to share my screen. Oh, and a quick note, tomorrow we can't do the show. I am out in the morning. So tomorrow we're going to be skipping it, coming back the next day. Forgot to
All
mention
right. So Thursday we're off, and we see everyone Friday.
Yep. So
Perfect.
and if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, or the analytics. If you do have a question, type it into the live chat on YouTube. Will's watching it and he'll read them back to me. And to give you guys a couple minutes to put those questions in, we'll start out and taking a look at the pre-market report to see if we could get insights, what's going on in the pre-market hours, and then we're going to move on to the questions. All right. So let's start out at the top here. And what we see is a calendar here that does allow you to go back in time if you wish to look back at a historical date, what happened in the pre-market hours on that specific date. And we do display about 1 week's worth of top level stats of what happened on that date in case we could spot some trends, eyeball some trends. So let's start out today here, January 31st. And so far, this is what's going on in the pre-market hours. We have 298 stocks that are trading higher in the pre-market, 381 stocks trading lower. As far as volume goes, we have 107 million shares trading on up volume, 65 million shares trading on down volume. If we convert that volume to dollar value, we have $960 million worth of stock trading lower. I'm sorry, higher, $960 million worth of stock trading higher, $3.7 billion worth of stock trading lower. So from that perspective, it looks like trading in the pre-market hours has a bearish lean. But let's go and look at it from a couple more perspectives, and then we'll move on to the questions. I'm going to scroll down, and now we see a list of stock symbols that are trading the pre-market hours. And we split it up into the most active stocks, the biggest percentage gainers, and the biggest percentage decliners. And down here, I see there are 47 stocks that made our largest percentage gainers, 82 on our largest decliners. So this also points to traders leaning towards the bearish side in the pre-market. Now, to make this list, we do set certain thresholds because stocks in the pre-market tend to be less liquid, low volume. So we have liquidity thresholds, volume, price thresholds to make this list. Now, any stock that's listed on a major U.S. exchange, if it meets those thresholds and it's trading the pre-market hours, it can make this list. So it could be a preferred stock, it could be a ETF, it could be an inverse ETF. So to narrow down this list to a smaller group, we could use the filters above. If you have a watch list and you created a group of stocks that you're tracking and you saved it, you could use this filter, just drop it down, select the watch list that you saved, and then this list will get updated based on those symbols. We're going to use this filter here in ETF for our example, and I'm going to click on it, and we get a list of different ETFs to choose from. I'm going to select this one, SPY. Let's do that. And when we do that, the list below will get filtered by stocks that are holdings in the SPY ETF, which are the, let me see, for some, I might have to refresh my screen here, Will, because I had it up for a while.
No worries.
Refresh my screen. And then we'll do that again. So in ETF, I'm going to come down here. Let's select SPY. And when we did that, the list below got filtered by symbols or stocks that are holdings in the SPY, which are the S&P 500 constituents. So here we see 12 stocks made our percentage gainers list, 23 on our decliners. Again, that points to a negative or bearish sentiment in the pre-market. Now, a couple things here. We have the stock symbols, the price changes, volume. But when we see this little E here, those alerts, the E is for earnings, N is for news if you hover over it. And I see that there are a lot of earnings right now coming out here on the gainers and the decliners. So if there was an earnings yesterday after the market closed, today before the market, even open, they could be releasing in the morning. The stocks are trading in pre-market hours, could be reacting to that. So keep in mind that we are kind of still in the earnings season. A lot of stocks are reporting, but so far we looked at it from, I think, 3 different perspectives, and all of them point to a slightly bearish bias in a pre-market. So, well, we gave it a couple minutes. I think I'll take questions now.
Yeah, actually, the only comment they were talking about, Mike was mentioning Amazon has their earnings today. I know earlier in the week we discussed real quickly that all the big 5 tech companies were reporting this week. I think it's a big earnings week, but he was mentioning Amazon. I don't know if you want to take a look at the Amazon earnings, what the Straddle's saying there.
Okay. Was it a question, or you're just suggesting?
No, they expect Amazon to have a big number today, and he's got some sort of spread on in Amazon. I don't know. I did an Amazon earnings play early this week. Could get hurt. No questions though.
Okay. So as we see here, right now I'm on Amazon, and it looks like Amazon is reporting February 1st after the market closed. Is that correct?
Yep. So that's tomorrow, actually.
Yeah. So we could take a look at the interactive charts here.
He actually did a spread too, if you want to put that into the profit calculator.
If he wants to look at a specific one, if he has it, we can.
He did a credit put spread 155.50, February 2nd expiration.
Okay. So let's take a look at that. So I'm going to go here to the options chain. And what we're looking at here, February 2nd, right? A credit put spread. So the puts are on the right-hand side, calls on the left-hand side, if you guys see that. So let's do the 155 put, right? For the credit, we're selling the higher strike, 155. So I'm going to click on the 155 bid here. So you can see here, selling Feb 2nd 155 put, and it populates the most recent or the most current price on the options chain. You can change it over here, but let's keep it at 365. And then you said it was the 150?
Yeah.
And then coming to the 150, we're buying that back, 202. So here we have selling the first leg, buying the second leg, Feb 7, 150 put for 202. So let's calculate that first. And what we see here is what the payout diagram looks like at expiration. So this one really is expiring, really the day after, right after earnings, the day after, right? So using this, we see that there's a credit of 163 using the prices on the last prices on the options chain. Looks like the bid and offer was a little bit wide, midpoint 170. Okay. There's the delta, gamma, vega. I think somebody asked about the vega yesterday or the gamma yesterday. And when we look at this diagram, right, and really you could almost visualize if you do a lot of credit put spreads in your head, but this shows us where the profits and losses are along different closing prices at expiration. So here we see, credit put spread, you have to have a bullish outlook. You have a little bit of cushion there because the stock is at, yesterday closed 159.07. So it's already above those strikes. So you could see here in the green, right? So if it goes higher, you just keep that 163. If it goes lower, it has to stay above 155 for both those options to expire worthless at expiration, and you keep the credit that you sold it for. Once it crosses that 155, you have a little bit of cushion because you still receive the credit, right? But then there's your break even and your max loss if it's below 150. So the payout diagram, it's just good to make sure that even visually, right, it aligns with your unique outlook on the stock. So remember, whatever analysis we do right now, we could go look at the theoretical value, we could look at, but there's risk exposure, and based on that risk exposure, the stock still has to do, that. That we don't know. We don't know what the stock's going to do. It's still uncertain. But let's do this while we're looking at this payout diagram. One thing we could do is say, well, we don't know what the stock's going to do, right? We don't know, but we could plot what did the stock do historically, right? Like, where did it end up after earnings the next day? Up, down, how far, so let's plot that. So I'm going to come over here, this drop down, and this is an earnings, right? These are earnings. We're going to plot display earnings moves. Okay, so I'm going to click on that, and we're going to say, show me the last 12 earnings moves. Okay, so what it's going to do when we've selected, it's going to plot these types of lines. You see where we have current move. It's going to plot these types of lines based on historical percentage moves. Right, so if it was up 10%, it'll plot a line up 10%. If it was down 10%, it'll plot a line down 10%. So we could see like a distribution of historical returns and where they fall along this. Okay, so let's take this, and I'm going to say last 12 moves. Okay, and here we go. So we could see that, it's just visually, to me, it looks like, almost evenly distributed, maybe a little bit skewed to the upside. Like, so you could see here, it went all the way up to here, so even this, you could stretch out because to the upside, you could see really big, but even to the downside, there are a lot of them that ended up, on that max loss. So now we have kind of so what are 12 moves? Keep in mind that earnings, are once a quarter, right? So when you're looking at 12 moves, it's not 12 days, the past 12 days, you're looking at like 3 years of data. right? Because you're looking at 12 moves, and that's why we're doing, well, what are the most recent, data? How did it look? And now we could see the payout diagram, and we overlapped historical moves on that payout diagram. All right, that's what we just did. And it allows you to, if you're looking at it, it allows you to move around the, maybe the legs. You could move them around based on that plot. But we'll keep it at that because we already did that. Let me just go 20% around. Okay. So that's one question. What about the implied moves? We could see the average of the implied, like where was the straddle? So we could see over here. So the straddle is basically priced right around the one standard deviation, around like that. So this is where the straddle right now, okay, the implied move right now, after earnings, those are the two lines, up or down. So the straddle right now is implying somewhere in between these two lines. So you could see here that, to the downside, yeah, you got the max loss here, to the upside max loss, but this is the range, those two lines where the current implied move thinks thinks that the stock will stay within that range, with a 67% two standard, right? One standard deviation on each side. What do we think, though, based on those moves? What do we think on average? The next question is, well, what do we think on average this spread is worth? Okay, so we saw that, just based on the last 12 moves. If we look at the last 12 moves, well, we see that sometimes the stock fell. There were a lot of times that the stock fell enough that this spread would be worth $5, right? The max between the strikes. In other words, if we have a put spread 155, 150, if the stock's below 150, this spread will be worth $5 at expiration, right? Both options will be in the money. So that's so there. Sometimes it'll be worth $5. Obviously, here it's already done that in the past. We don't know what the future, but it's not unreasonable to think it's been done that plenty of times. Sometimes the stock just goes up, and if it stays above the 155, well, then this spread is worthless at expiration. Both options are out of the money. It's worthless. So sometimes it's worth $5, sometimes worth $0, sometimes it's somewhere in between, right? And what we want to see is, just based on those historical distributions, what do we think the average value over long term is, and based on that average value, are we selling the spread above it or below? So you always want to sell it for more, right? The more, if you're selling a credit put spread, the more you get, the better, right? Because the lower you sell it for, the less credit you receive and the more risk you have, right? The higher you sell it for, the more you receive. So when we're selling it, what do we think, on average, what is the average? We need a benchmark, right? A baseline. So what do we think on average it's worth? So let's go here to the distribution theory. And now I'm on the distribution theory. I have 4 years of data here. Okay. And we're going to switch it to over here to only earnings periods. Because right now it's looking at all periods. So I have 167 different observations, for a 3-day hold. But obviously, I don't need the periods right now that are just regular days with no earnings. It's gonna just bring down the averages. So I need to look at only those periods when there are earnings. Okay, so we got to switch this model to only earnings periods. So I'm going to select that, and I'm going to reload it. So based on this, if we use the last four years of data, right? So instead of 3, I'm going to 4. So this is 16 observations. And if we looked at what the stock did in those 3 days that cover earnings, right? So because this is, remember, we're using yesterday's data still because we're not open yet. So if we looked at those 16 observations, 4 years of data, what we see is, on average, right, this spread, if we using that distribution, using the distribution, historical distribution of returns, based on that, on average, this spread in theory would be worth $1.25. Basically, if we averaged all those out, right? So that's $1.25. So, then if you're selling, it's like you are selling above that average benchmark, right? So that's one way we could compare the market prices to a theoretical value, right? To some kind of baseline. And what else we could see? So that's like a 38 cents. That's, so if you're selling it above, right, it's like a 38 cent. What this is saying is theoretical edge. You're selling it 38 cents above that historical. How often? Then the question is, okay, that's the average. But sometimes, sometimes you would have been a loser if you sold it for $1, assuming this $1.63. Well, it's not. It wasn't always a winner. And by the way, we don't know the future. Anything could change in the future. But what we want to know is, how often was it a loser in our data set, based on just the data set that we're testing it on? How often would have this resulted in a loss within our data that we're analyzing it, and how often would have it resulted in a win? So this is saying that 75% of our data, right, in this 16 observations, 75% of the data is displaying that, right, verse 163, this would have resulted in a win. In other words, the value of that spread would have been below 163, allowing you to purchase it back for less than you sold it for. So that would have been any win, right? Doesn't mean the whole, $1.63, but any win. It was below 163. So if you bought it back for 150, that's a win. If you bought it for 140, that's a win. If 0, obviously that's a win. And 25%, that means 25% of our data, of this data, would have resulted in a loss, where you would have ended up having to close out of that spread or whatever if it expired, but the end value of that spread was higher than $1.63. Right? This is doing all the conversions for us with the percentages and stuff, but it would have resulted in a loss, because if you're buying it back for more than you sold it, well, now your net pain, right? It's a loss. You received the $1.63. If you're buying it back for $2, that's a loss. If you're buying it back for $5, that's a loss. For $3, you're buying it back, that's a loss, because you're paying more than you received. So 25% of the data indicates that you would have been buying it back for a loss. So and we could change the years around, right? We could do, well, what if we expanded it or narrowed it? So you could see here 6 years and so forth. Another question might arise. Okay, that's one way to look at the credit spread. Another way is, well, let's forget about what the stock did and see how were the options priced historically. Maybe the options are always priced this high, or maybe even higher, or maybe lower. So ignoring how the stock did at this moment in time, are the prices high or low? Because remember, you don't have to, you still have all day today, right, to perhaps buy back as well, sell and buy back, who knows? But are the current prices, the premiums for this stage, right, this state that we're in right now, one day before earnings, how are the options usually priced at this moment? And are they high or low? Because the options could be, there's a divergence between the actual historical and where the options are priced. So where are they usually priced here? And that's what this IV Theo is. So let's go to the IV Theo. And the IV Theo says that based on these options, 3 days to go over here, we have two options here, 3 days to go. There's an earnings coming up. Show me the data. So this is looking at the implied vols of two similar options, using those implied vols to convert it to what the spread would be worth today, right? So you can see here, historically. And then it's saying, okay, what is the average that a similar spread would have been priced at? So it looks like $1.49. And you can see here the range, 92 and 169. So that's also above there. So price-wise, theoretically wise, it looks like that the spread is trading at above, like you're getting a little bit extra above a historical benchmark. However, keep in mind, the stock still, even though you're getting that extra, the stock still has to do that, right? That doesn't mean that if the stock drops, because we don't know that. We don't know where the stock's going to end up. The idea is, since we're getting extra, the stock could drop and we could be losers, right? But even though you're losing, it's like you didn't lose as much because you got a little bit extra, right? It's like you could have been selling it down to $1.25 or something like that, and even lost more. But if it's a winner, it's like you made a little bit extra because you sold it for above that benchmark that usually it trades. So that's what to say. We don't know what the stock will do, right? It could definitely collapse. That's a directional risk. You're assuming that directional risk with this strategy because that's your exposure. So keep that in mind. The stock still has to do, this part for it to be a winner. But, looking at the theoretical values, and, you can look at it as maybe it's a signal that, maybe the market's signaling we're too high as well. It's something to consider. Or if you do believe that, there's a better chance we're up, then in theory, that the prices right now are above those historical baseline benchmarks. All right. Well, we're right at actually over 9.
Yeah, we're a minute through. That was very helpful, D. Mike says thank you. Great job as always. No show tomorrow, everyone. We will be back on Friday. So you have a great trading day today, tomorrow, and we'll see you Friday. Thanks, D.
All right. Thanks, everyone. Stay safe out there. Have a good trading day, and we hope to see